Hi. In the far-off year 2000, when I was a quarter century younger, internet stocks flew to the moon. Savvy tech companies took advantage of investors' undue enthusiasm and sold shares to greedy investors at huge multiples of their real value. Then the market crashed for 2.5 years into the depth of 2003, when the surviving stocks were selling at rock bottom prices. Some, in fact, were selling far below rock bottom, that is, below cash value, because management were paying themselves too much out of proceeds of their IPO, so the companies were bleeding cash. At the time, I was running a value tech fund named Giraffe Capital. We were renting an office from friends of mine who ran their own private money in a family office. There was another guy there named of Martin who ran the fund of his own. One day, he and I chatted about all these former high flyers now selling at a fraction of their previous prices. Many, Martin said, were selling at less than the cash value, the net cash value, net of all that. In technical terms, this is called negative enterprise value. Enterprise value is market cap minus all debt. In this case, the market cap minus or plus all debt was less than the cash. It is the equivalent of buying a wallet for less than the value of the cash stashed in it. In a feat of creativity, Martin suggested we call them walking wallets. Why? Because these stocks were like a man holding a wallet full of cash walking down the street, but the wallet has a hole dripping out cash. The question is, can you run and stop the man in time and stop the bleed to get the cash? The longer the bleed lasts, the less cash you will get. But how much less? In a fit of enthusiasm, Marty and I wrote down a portfolio of 10 such companies of negative enterprise value. He picked 5 and bought them, and I bought 5. Now, please note, we bought them blind on the numbers without sleuthing any of them individually on a physical level. Remember that part, because it was a mistake. Nevertheless, 2 years later, Martin sold his handful of walking wallets for a triple of what he paid for, and I, who held mine a bit longer, sold them for 3.5 times. Both of us congratulated ourselves profusely for being geniuses. Or were we? No, we were not. We were idiots, because some of these walking wallets became multi-baggers, 6, 7 times, even 10 times and more. Like which? Like stamps.com, and 1 or 2 others. 13 and 14 and 15 baggers. If we had bothered to sleuth them individually, rather than buy them blindly on the numbers, we could have made 2 and 3 times what we did. So why do I mention this, except for admitting past idiocy for self-instruction purposes? Because a few days ago, I noticed that one pharma company plunged a lot and officially became a walking wallet. Which one is that? It is Real Media Therapeutics, RLMD symbol. I had put it on my watch list because Michael Berry, the autistic doctor who had made a fortune shorting junk bonds, bought some. I learned this via a website that follows what smart hedge funders like Berry are buying or selling. Of course, just because Berry bought RLMD didn't mean it was good buy because I haven't sleuthed it yet. I learned my lesson. But because Dr. Berry is smart, I still wanted to know what he was doing, which is why I watched RealMed. So why am I noticing it now? For 2 reasons. First, because it just plunged and became a walking wallet, as noted above. But second, why did it plunge? Because management realized the R&D is not likely to produce any product, and so cut it all off to save costs. Before RLMD plunged, it has shown a big potential value in R&D spendings, which were about $100 million the last 3 years. At that time, before the plunge, the enterprise value was about half the R&D, which on the face of it is cheap, if the R&D proves productive. Of course, now that is immaterial, because management just stopped all R&D spendings, which is what made the stock plunge. And because of the plunge, the stock now is at 45 cents, trading at far less than cash per share. And so enterprise value is negative 40 million, and cash is 70 million. What does it mean? It means you are paid a gift of 40 million to get a cash hold of 70 million. But since this particular walking wallet is also dripping cash, you would be right to ask, how long will the cash hold last? Well, Free cash flow is minus $19 million per year. That is the amount of annual drip. So the cash would last about 2 years. Is there any other value there? Well, book value is another number to look at, and book value is $2.84 per share. Yes, $2.84 book value for a share price of 45 cents. And don't forget, if there's still any residual value in the discontinued R&D, it would be a sherry on this juicy cash cake. But is there value in the R&D? I don't know. I do know, however, that management stopped the FDA testing because success was unlikely, but perhaps another company could use partial results. One thing is certain, the R&D cut and the stock's plunge are a great disappointment to all in the company, especially since for the last 2 years, everyone was buying stock at $4, $2, and $3 per share. The stock is now less than half a buck per share. And the company is also dripping $90 million per share per year. Sorry, $90 million per year, unless they cut cost. Will they cut cost? I, of course, don't know this. I only know that there's a bunch of executives in RealMed that spent an average of $3 per share for a stock and are now under 80% underwater. Will they fold the company or sell it and get the cash? Or maybe there's some value still in the R&D that someone else can use. All these are good questions that you can only find by sleuthing the company. But sleuth how? You got it. You can sleuth it as per my book, The Sleuth Investor, when you see the method spelled out. Is the stock worth sleuthing? I think so. At the very least, the stock just became much more sleuth-worthy target. Lots of cash, lots of book value, maybe some R&D value as well, and plenty of motivated management who may look to salvage the stock loss. Can it be salvaged? Can the company bring the value up to cash? Or can it perhaps one day be another Stamps.com where Ian Martin sold too soon? All these are excellent questions for you to answer as a sleuthing exercise. Who of you will do it first? And who of you thinks the answer might be yes, or maybe no? You tell me. After you've done your physical sleuthing. Yes, physical. This means internet off and gumshoes on. See? That's all for today. Please let me know if you like the above. And if you do, give it a like, subscribe to the channel, and retweet to all your friends and subscribers that I subscribe to. And buy my books, The Sleuth Investor and The Advanced Sleuth Investor, so you can learn the methods of taking the money of all the lazy bones, stay-at-home investors who haven't read any of my books. I'll see you next time, and meantime, thank you very much for watching.